Okay, so this PowerPoint is going to wrap up Chapter 6 for us. This is actually going to be the very last PowerPoint of this whole course. Let's get to it. So in our last recording, we looked at preparing financial statements, which was more of a bit of a review. And now we're going to look at closing entries and our post-closing trial balance. Those are the last two steps in the accounting cycle. So this is steps number 8 and step number 9. So let's start by talking a little bit about closing entries. So at the end of the accounting period, the company makes the accounts ready for the next period. So the last step that we have to do to wrap up this reporting period was create those financial statements. Now, steps 8 and 9 in the accounting cycle are to actually prepare our accounting records for the next accounting period. So the beginning of this process is called closing the books. In closing the books, the company is going to distinguish between what we call temporary accounts and permanent accounts. So let's talk about the difference between a temporary account and a permanent account. So temporary accounts relate only to a given period. So what do I mean by that? There's certain accounts that we have that we want to basically start fresh every reporting period. So for example, an expense account. If I want to track how much expenses I have during that one reporting period, then I need to start fresh every period. So these temporary accounts are going to include all income statement accounts. So what goes on an income statement? Income statement has our revenues and our expenses. So when I say income statement accounts, that is what I'm referring to, is revenues and expenses. The other account that we want to start fresh every reporting period would be our withdrawals account, keeping track of how much we have removed from the business for our own personal use. So at the end of every reporting period, the company will close all temporary accounts. And what that means is we bring them back to zero. Now, a permanent account, on the other hand, or what some people refer to as real accounts, are our balance sheet items. So what goes on a balance sheet? Assets, liabilities, and equity. Those are the accounts that we want to carry forward from one accounting period to the next. So however we finish the previous accounting period is how we want to start the current period. So we bring all those balances forward as we move along. So closing entries are only going to be made to our revenue, expense, and withdrawals account. And like I said, what that means is we are going to bring all those temporary accounts down to a zero balance. Let's look one more time at the difference between permanent and temporary. So permanent accounts are our balance sheet accounts. These are the accounts that we're not going to close. These are the accounts that we want to bring the balances forward to the next accounting period. Now I have cash here, and that should actually say assets. So assets, liabilities, and our owner's equity. Those are going to be our permanent accounts, and we are going to take those balances forward to our next accounting period. Our temporary accounts, those are our income statement accounts, meaning our revenues and our expenses, and also our owner's withdrawals. These accounts here, these temporary accounts, are the only ones that we're going to close, that we're going to bring our balances down to a zero after each and every reporting period. So how do we go about doing this? Well, there's two different methods. One is the direct method, and the second is what we call the income summary method. And we're going to look at both methods. My preference is the income summary method, but some people do like the direct method. So in the direct method, we're going to close those accounts, so their revenue, expense, and withdrawal accounts, directly into our owner's capital. So at the beginning of the period, the balance sheet is in balance. T accounts here are being used to illustrate the three categories. So we currently have $10,200 in assets, $4,900 in liabilities, and $5,300 in capital. So our assets right now are equal to our liabilities plus our equity. So when we provide services to a customer who pays cash, that will take our balance sheet out of balance because our asset would increase with that cash. When we do work for somebody, it would also increase our revenue. But at this point in time, that is not part of our balance sheet. The same type of issue is going to come up when we say, let's receive a telephone bill. So a telephone would be an expense. Again, that's going to show up on our income statement, but not on our balance sheet. So we would owe more money, but we haven't recorded the expense onto our balance sheet yet. So as of right now, we are out of balance again. Now we want to get that balance sheet back into balance because we know that a balance sheet has to balance. So to get the balance sheet back into balance, the owner's capital must be updated with the revenue and expense transactions. So let's start with our revenue. Now, what effect will revenue have on our equity? We've known this from the first couple chapters. Revenue is going to increase our equity. So let's take a look at our revenue account. Revenues, of course, increase on the credit. So we say we have $1,500 in revenue. Now, if we want to bring that balance down to zero, what should we do with it? If we want the balance to be a zero, what we're going to do is we are going to debit it. But we can't just have a debit without a credit. So what do we want to do? We want to take that $1,500 and we are going to credit it to our capital account. Now, when you credit capital, what effect will it have on our capital? It's going to increase it. So think about it. Our revenue, we're simply transferring the balance of that revenue directly over to our capital account to increase our equity. Now let's talk about our expenses. Remember that telephone expense of $250. What effect will an expense have on our capital? Of course, an expense will decrease our capital. So let's look at this situation. We have a current balance of $250 in our telephone expense. Remember, expenses increase on the debit side. So if we want to decrease that expense to bring that balance down to zero, what we're going to do is we are going to credit it. If we have a credit, we know we need a debit. So we're going to take that $250 and transfer it over to our capital. Capital, of course, increases on the credit and decreases on the debit. And we said that an expense would decrease our capital, and that's what we have done here. And our expense account now has a zero balance. So the end result is that our owner's capital will have a new balance and our balance sheet will be in balance again. Our assets will equal our liabilities plus equity. So notice that the revenue balance is a credit and the expense balance is our debit and the owner's withdrawal balance is a debit. To reset or close the balances back to zero, to prepare for the next accounting period, we must decrease the value of each of these accounts. So revenue will always be debited, expenses will always be credited, and our withdrawals will also be credited. In the context of closing entries, the terms close, reset, and zeroed out can be used interchangeably. So what will these journal entries look like? Now remember, we wanted to decrease or zero out those revenues. So we wanted to decrease our revenues. So how do you decrease a revenue? We debit it. So you can see here that we have service revenue as our debit, and we closed it directly to capital. So capital will be our credit, and that is going to increase our credit, and it will decrease our revenue. The next entry, we said all our expenses, what we were going to have to do to bring their balances to zero was to credit them all. So they will be our credit, And if they're our credit, then capital would be our debit. And that is decreasing our capital and decreasing our expenses. And lastly, we have our withdrawals. Withdrawals increase on the debit and decrease on the credit, so we're wanting to decrease it, so it's going to be our credit. And our, I apologize there, my pointer went. So withdrawals will be our credit and capital will be our debit. So let's take a look at what the effect on equity will be because of this. So we said we had a current balance in our equity of $10,300. And then when we closed our revenue, we increased our capital by $4,500. When we closed our expenses, we decreased our capital by $1,325. And when we closed our owner withdrawals, we decreased our capital by $2,000. So we would add these two together and then subtract our expenses and subtract our withdrawals, and we end up with a brand new balance for equity of $11,475. Okay, so we looked at the direct method. Now let's look at what we call the income summary method. So with the income summary method, the difference here is we're going to open a new temporary account. So this account is going to be opened just for the closing process. We're going to use it in a couple transactions and then we're going to close it again. The name of that account is income summary. Okay, so it's income summary, not income statement. Make sure that you notice the difference there. So the name is income summary. What it does, it summarizes our income. How do you figure out an income? You figure it out with revenues and expenses. So what this account is going to do is it's going to be almost like a placeholder where we're going to transfer the balances for revenues, transfer the balances for expenses, and then figure out whether we have a net income or a net loss. If we have a net income, it will increase our capital. If we have a net loss, it will decrease our capital. So let's look at our example over here in the visual. So here we have our service revenue. Our service revenue has a credit balance, so we increase on the credit side and decrease on the debit side. So it currently has a credit balance of $1,500. If we want to bring that balance down to zero, we will need to credit that account $1,500 and then we'll have a balance of zero. But we have a debit, so we know it needs to go somewhere as a credit. So we're going to transfer that to the credit side of income summary. So we have $1,500 on the credit side of income summary now. Let's take a look at our expenses. With our expenses, we increase on the debit and decrease on the credit. We currently have a debit balance of $250. So if we want to bring that balance down to zero, we're going to transfer that balance over to the credit side, which will then give us a zero balance. So if we have a credit, we know we need a debit, so we're going to transfer that balance over to our income summary on the debit side. Now let's take a look at income summary. We have $1,500 on the credit side, and we have $250 on the debit side. So what we want to do is we want to balance that. So we would subtract our debit from our credit and we get $1,250, so $1,250. Now what we want to do is we want to decrease this down to zero. So we're going to transfer that credit over to the debit side, which would give us a zero balance in income summary. That debit is then going to be transferred all the way over to the credit side of our capital. Let's talk about this for a moment. Our $1,500 balance here was a result of our revenues. The $250 balance on the debit side was a result of our expenses. So we had $1,500 in revenue, $250 in expenses. Would that result in a net income or a net loss? Of course, it would be a net income. What effect would a net income have on capital? A net income would increase our capital, and that's exactly what we've done here, is we have increased our capital by that $12.50. Okay, so then we add the original amount of our capital to our increase with our net income, and we get a whole new balance for equity. So let's take a look at the difference. So we have, in the direct method, we have our assets and our liabilities, which are permanent accounts. Nothing's going to happen to them. Then we are going to take our revenues and we transfer the balance directly to our capital. We take our expenses, transfer the balance directly to our capital, and we take our withdrawals and transfer the balance straight to our capital. The revenues, of course, will increase our capital, the expenses will decrease it, and our owner's withdrawal will decrease it as well. Now, with the income summary method, again, our assets and liabilities remain untouched. Now this time, instead of putting our revenues and expenses directly into our owner's capital, what we want to do is transfer it into our income summary. So our revenues will increase our income summary and our expenses will decrease it. The income summary account will summarize our income. Do we have a net income or do we have a net loss? If we have a net income, it will increase our equity. If we have a net loss, it would decrease our equity. Owner withdrawals, doesn't matter which method you're using, we close those directly into our owner's capital, and it's always going to be a decrease to capital. Let's try a quick little quiz. Which of the following types of entries is required to close an expense account? Is it going to be a debit to expense accounts, a credit to expense accounts, a credit to income summary account, or a debit to owner's drawings account? So when we're closing our expense accounts, which one of these must be included? Okay, if you chose B, then you would be correct. It would be a credit to the expense account. So let's talk about that for a moment. Let's draw our little T account. We have an expense account. Expenses always increase on the debit and decrease on the credit. So if we had a balance over here on the debit side, if we wanted to bring the balance to zero, we would need to transfer it over to the credit side to bring our balance down to zero. So it would be a credit to our expense account. Now, which of the following types of entries is required to close the owner's withdrawal accounts? Is it going to be a debit to owner's drawings account, a debit to owner's capital account, a debit to our revenue account, or a credit to our capital account? What do we think? And if you chose B, debit to the owner's capital account, you would be correct. So let's talk about capital for a minute. Capital increases on the credit and decreases on the debit. If we're closing our withdrawals, what effect will that have on our capital? It's ultimately going to decrease our equity. So it would be a debit to our owner's capital account. Now let's try a little exercise. Let's work on what it's going to look like when we close our revenue and expense accounts using the income summary method. All right, so here is our trial balance. What we want to do is we want to close our revenue and expense accounts using the income summary method. So let's take a look at our trial balance and find all our revenues and expenses. Now, unearned revenue has the word revenue in it. Is that a revenue? No, that's a liability, so we don't touch that. That is a permanent account. Let's move down here. We have a revenue here for service revenue, and then we have several expenses. So we're going to start by journalizing our entry when we close our revenue account. So we take a look, we have service revenue here, and it currently has a credit balance of $6,400. So we have a credit balance of $6,400. if we want the balance to be 0, what will we have to do to it? If we want the balance to become 0, we are going to have to debit our revenue. So we put service revenue as our debit for $6,400. That has now given us a 0 balance for our revenue. But we need that revenue to go somewhere. And what we're going to do is we are going to send it over to our income summary account. So our income summary account will be our credit. So we have service revenue as our debit and income summary as our credit. Anytime we close revenue, this is what the transaction is going to look like. It's always going to have revenue first and income summary second. We would then write a quick explanation like close service revenue. Revenue is now closed and has a 0 balance. Let's take a look at our expenses now. So we have an advertising expense, a depreciation expense, a rent expense, and a telephone expense. Those are all our expenses. And all of these currently have a debit balance. So if they all have debit balances, and we want the balance to be 0, what will we have to do to it? We will need to credit our expenses. Now, when journalizing, we know that debits always have to come before our credits. And we're going to be transferring the balance of all those expenses into our income summary. So we're going to place that here first with income summary as being our debit. Now you'll notice I've left this blank. This will be the sum of all our expenses. So we'll then take all of our expenses and bring them over to our journal entry where they will be credited. So we have them all listed here as our credits. Now what we need to do is come up with our number for income summary. To do that, all we're going to do is add up all our expenses. And we get 1,320. So anytime we close an expense, it's always going to be income summary as the debit and our expenses as the credit. Don't forget your explanation, so we could simply write to close expense accounts. Our expense accounts are now at 0 and they're ready for the next reporting stage. Okay, so our revenues are closed, our expenses are closed, but we still have income summary that is holding our net income or net loss. And we also have that withdrawals or drawings accounts that also needs to be closed. Now let's take a look here at our trial balance again. We are saying that we want to close our income summary and our drawings, but we don't have any information here for our income summary. It is going to be in those journal entries from when we closed our revenue and our expenses. Now let's take a look. We had a credit to our income summary when we closed our revenues, and we had a debit to our income summary when we closed our expenses. So what I like to do is I like to draw a T account. So we will debit our income summary for all our expenses, and we will credit our income summary for all our revenues. We'll subtract our expenses from our revenues, and we end up with a balance in income summary of $5,080. So that $5,080 is actually our net income. We've taken our revenues, subtracted our expenses. That's what's left over. So it is actually representative of a net income. Now remember, we want to close our income summary. So how are we going to do that? We currently have a credit balance. So what should we do to it to bring the balance of our T account down to 0? We're going to want to debit it. We take our journal entry and we are debiting our income summary $5,080. Now, what will be our credit? We know what our debit is. What's our credit going to be? When we close income summary, we are going to transfer the balance of it into our capital account. Now, we had $6,400 in revenues and $1,320 in expenses. Did that result in a net income or a net loss? Of course, it was a net income. Our revenues were higher than our expenses. What effect will a net income have on our capital? Of course, it will increase our capital. How do you increase capital? You increase capital with a credit, and that's what we're about to do. So our capital will be the credit. Now, an important note here. We said when we closed revenues, it was always going to go revenue and then income summary. We said when we closed expenses, it was always going to go income summary as the debit and our expenses as the credit. Now, this one, income summary and capital can flip back and forth between debit and credit depending on whether it's a net income or a net loss. If it's a net income, income summary will be the debit. But if it's a net loss, we would want to decrease our capital. So our capital would be the debit. Again, don't forget your explanation. So we just simply said to close income summary. So at this point in time, our revenue has a balance of 0, our income summary has a balance of 0, and our expenses have a balance of 0. So what's left? The next thing we have to deal with is our drawings or withdrawals. So let's take a look. We do have a withdrawal here, and our withdrawal is for $1,500 as a debit. So if we want to bring the balance of that withdrawals account down to 0, what are we going to do? We are going to credit it. Now we said it didn't matter which method we were using for closing entries. Withdrawals always closes directly into capital. What effect would a withdrawal have on capital? It would, of course, decrease our capital. How do you decrease capital? You decrease capital with a debit. So we're going to start off by saying green capital with a $1,500 debit. We would then credit our withdrawals, $1,500. And we would simply write the explanation, something like to close owner withdrawals. Now, just a quick little review. Anytime we close revenue, it's always going to say revenue as our debit, income summary as our credit. When we close expenses, it's going to have income summary as our debit and our expenses as our credits. When we close income summary, if we have a net income, it will have income summary as our debit and capital as our credit. Whereas if we have a net loss, our capital will be our debit and our income summary will be our credit. Anytime we close withdrawals, it's always going to have capital as our debit and withdrawals as our credit. We're almost done. There has now been changes made to our capital account, hasn't there? When we closed our revenue, it increased our capital account. When we closed our expenses, it decreased our capital account. And when we closed our withdrawals, it decreased our capital account. So now we have to calculate a new number for capital. Okay, remember when we closed our income summary? Our income summary was a result of closing our revenues and expenses. So when we closed our income summary, we had an increase to our capital account, so a credit to our capital account of $5,080. Now remember, we're not closing capital here. So it was a credit, it's going to remain a credit. So our opening balance for owner's capital was $8,100. And then we had an increase because of that net income that was in our income summary of $5,080. So that's another increase. Then when we closed our withdrawals, we had a debit or a decrease to our capital. So now we have to put that into our T account. So we come over and we decrease with a debit of $1,500. So then we balance it. We take that opening balance, we add in that increase from when we closed our income summary, and then we subtract that decrease from when we closed withdrawals, and we end up with a new balance of $11,680. That is our new closing balance. All right, folks, that is it. You are done. This is the last PowerPoint of the semester. Congratulations.